Hello and welcome to episode 6 of the Talking Central Banks podcast with me, Karan Medici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about sovereign debt management and the implications of unsustainable debt to GDP ratios across the world. Our guest tonight is eminent sovereign debt management expert Gregory Makoff. Gregory has been a Center for International Governance Innovation Senior Fellow since 2015. He is an expert on sovereign debt restructuring and is the author of Default, the landmark court battle over Argentina's 100 billion debt restructuring. Between 2023 and 25, Gregory was a senior fellow with the Mossavar-Rahmani Center for Business and Government at Harvard's Kennedy School. Prior to this affiliation with CIGI, Gregory worked for 21 years at Citigroup, specializing in debt advisory and liability management for sovereign borrowers, corporations, and financial institutions. He helped countries around the world restructure their debt, including the government of Iraq in 2006 and the government of Jamaica in 2010 and 2013. Between 2015 and 16, Gregory was employed as a senior policy advisor at the US Department of the Treasury, working with the domestic finance team that supported the enactment of the Puerto Ricon Oversight Management and Economic Stability Act, or PROMESA, the law which facilitated the restructuring of Puerto Rican debt. Gregory holds a Ph.D. in physics from the University of Chicago. Welcome to the show, Greg. It's great to have you here.
Thank you for having me.
My pleasure. So, first and foremost, Greg, please tell us about your book. After a 20-year career on Wall Street, why quit and write a book on sovereign debt management?
There are a few pieces, personal interests and career events that leads one to do something like that. And there are an assortment of Wall Street types who've written books, and I love a lot of them. And I did work in debt restructuring, debt advisory, liability management around the world in a lot of developing and developed countries in the middle of transactions, in the middle of negotiations. And the sovereign debt restructurings where the IMF is involved, the sort of things you hear a lot in the paper, like Greece's restructuring, the sagas that go on for years that are very political. I was in the middle of things like that. And I felt, wouldn't it be great to have a book where readers are in the room so they can understand this really complicated but important part of life, which very few understand except experts, the same ones called into every deal. And I thought, that's a story that hasn't been told, and I could help the literature. In sovereign debt, most of it's written by economists, and it's unfortunately really boring, or lawyers, and it's really hard for anyone to understand. And I'm kind of like a commercial person saying, no, this is how it really works. But the personal part is we all are affected by the events that occur in our life. In the current college generation, it's COVID. And those who are a little older, it's the great financial crisis. For me, I started college the month Mexico defaulted in 1982, probably the week Mexico defaulted, triggering a decade of less developed country debt crisis, like Greece, but it was 35 countries or something, and it went on for 10 years. I became obsessed with that. So even though I went to Wall Street, I always wanted to do sovereign finance. I always wanted to understand how the restructuring works. So in a sense, writing the book let me get some work experience and go back to what was my original formative obsession, was how does this relationship between borrowers and lenders in developing world works? Are the countries being unfairly penalized by creditors? Or as the creditors say, no, the countries aren't behaving well. And it's fascinating. That's why I got into it.
Okay. So, Greg, can you give us a broad brush policy outline of the events in the book as it unfolds?
The the book, to be readable, is advertised as a court drama.
Right.
I didn't think a
That's
lot of
interesting.
people would want to read a book on debt sustainability analysis.
Hmm.
And IMF's written great reports on that. So I wanted to bring readers into the room during a negotiation, but Argentina's went really badly and ended up in court for a decade. And it had
Right.
a cranky judge that made some really wild rulings. So I said, why don't I write a book that's a court drama and suck readers into it and give a background of facts about the dispute and why this messy debt restructuring had a lot of non-participants because
Right.
of fights over the terms, and then it ended up to court, and then weird things happened. And, kind of like when a car works, you don't really understand how it works. But when it's in a big crash, you see all the insides. So it's
Yeah.
kind of like you get to see all the insides. So it's particularly instructive. So
Hmm.
people who are more financially oriented call it a thriller, but I would say it's not for everyone. Um, it might not be for your grandma, but if you're interested in finance, central banking, a bit about law,
Yeah.
people like that love it.
So it's a thriller for central bankers.
And debt managers and IMF
Yeah.
staff and
Okay.
portfolio managers.
Very, very interesting, Greg. Your book touches upon a lot of currently relevant topics, Greg, and you have been writing pieces about both Milley and Trump this year. What does this saga teaches us from the central banking perspective?
Yeah, I'll step back. The saga teaches on a number of different levels, and I'll touch on them and I'll get
Mm.
to your question. The first is it just acculturates you into who are the players and processes in a sovereign debt restructuring. So if you read a newspaper article about the next Greece, you
Right.
get the language. The second one is sovereign debt had a big problem, which was solved by these cases.
Yeah.
And the world adopted these voting clauses in sovereign bonds. And as you know, the euro area after Greece adopted
Mm.
voting clauses like these two,
Right.
which involve a majority vote and a collective vote. Sovereign bonds for developing countries added them in 2003 and changed them to be more powerful in 2014. If 100 years from now, a banker or a law student, a central banker says, why do we have these particular clauses in sovereign bonds that aren't in corporate bonds and other types of bonds? The answer is those messy Argentina cases. And so that's the number one architectural world lesson is when you have dispersed creditors, you must have a mechanism to bind everybody to the same deal. You can sit down with your lead creditors, you can have a reasonable negotiation, but if you can't bind the last 10, 20% who might just disrupt you, like some
Right.
did in Greece and Argentina, the world doesn't work. And that is a major policy success for all the proponents, including John Taylor at Treasury and Ann Kruger. So, in terms of the way the world works, that's the major lesson. But something extraordinary happens during the course. Argentina has a major default in 2001. It has fixed
Right.
its exchange rate, has become uncompetitive. They're not balancing their budget to pay off their historical debt. Um, and they get in deeper and deeper trouble as the 90s go on. And after a several year deep recession, they default. The IMF says their debt's unsustainable. They withdraw funding. They need to devalue. They need to cut their debt. They're in a banking system crisis. The economy is in a free fall. People are protesting in the street. It is the worst case scenario. And Other countries had restructured their debt before, but Argentina ended up getting in big fights with the IMF and creditors. It took them 15 years to figure it out. Now, it turns out Argentina kind of correctly wanted a very deep haircut. They said, we don't want to get in trouble again, but they pushed it too far. And that ended up making it a mess. But on top of that, despite getting a very deep haircut, before their horrible events in court described in my book, they got 92% of their debt restructured at 50 cents on the dollar or better. They did really well. But then they started overspending. And so even though they make all this noise about blaming their foreign creditors for hurting the country, the fact is during the depth of the crisis, that a disciplined finance minister, Roberto Lavagna, who ran like a 5% surplus, and the economy stabilized very quickly. Then they fired him after the debt restructuring got on, and the populists in the government, the surplus went away. They went to flat to negative to a negative 4% primary, and then they're falling back into crisis again, and they end up in a maxi crisis before Milei was elected. And so it's a lesson about, you can make a lot of noise about the stock of debt, but in the end, the debt crisis is about public policy. If you can't deal with the year-to-year flow of your budget and manage the demands of voters for more stuff, then you're going to get in trouble. Typically, it's fiscal, you overspend, and you either borrow too many bonds or you print too much money. And Argentina redefaulted in 2020. They also so over supplied their local market, flooded the monetary base. They got almost hyperinflation. They were going over 150% before Milei was elected. And in the middle of it, all the road markers for today's trouble in the US are there. She fired the head of the central bank in January 2010. She knocked out the head of the statistics agency in 2007, and they started misreporting inflation, and that spooked the market, and the equity markets stopped investing in Argentina because they couldn't trust the numbers. So this bigger story that public policy really matters seeps through the story in the background, but it's not what the book is about. There's not a lot of charts or tables, but as Argentina is fixing this hard problem of restructuring debt without these collective action clauses with a difficult judge, they're making the historical mistakes again.
Can you also elaborate on the Argentine policy trajectory through Milei, Greg? Because I think even before Milei, the problem actually the problem has a much longer timeline, right? I mean, it started much before 2001, as you mentioned. So how did this evolution actually happen over the years?
Well, people talk about Argentina defaulting 9 times in 200 years, and they're bad people. I just ignore all history before the Bretton Woods system broke down. I just think we're dealing with an entirely different universe once you give up the gold standard. We have big imbalances funded with debt, which led to the LDC crisis and the sort of capital flow, debt crisis, monetary things we're dealing with today. So wipe away all that older history where Argentina and the rest of the world had problems, and Argentina may have been better than most. In the 30s, Argentina didn't default, and they had a good central bank. They were the first in Latin America to do it. But in the Brady plans, it's kind of like what I'll call the class of 1993. Like 30 countries restructured their debt. They were all in default in the 80s. They all restructured, and let's say 20 out of 30 haven't redefaulted. Brazil hasn't, Mexico hasn't, Panama hasn't, Peru hasn't, Philippines hasn't. Well, why did Argentina? Why, when all their peers in the same time period under the same global situation, Argentina does so much worse, and Venezuela does so much worse. Populist governments who are spending more than they can afford, and typically also blaming foreigners for their problems.
Mm-hmm.
And so it's that kind of thing. And so when I think about that context, I think about the tendency for Argentina to go through a reform urge, because it's not all, the country is split. They have always had a reformist sort of wing, and they have the leftist sort of wing, which is more dominant over time, and they can swing between the two. And the initial government after the 2001 default ran a very good fiscal policy, as good as Milei. But as I said, they fired the minister and then overspent. But what happened is they didn't follow on and clean up that debt restructuring. It took 15 years and it got to be a mess. So what happened is they never properly resolved the default of 2001. It took them so long to get the debt sorted, and before the debt sorted, they're messing up the economy again, fiscal and monetary policy. So I believe Milei had to come because the country never properly recovered from its default of 2001. It had a
Right.
few good years of stabilization, and then it went back to the old ways. And that's the question for the midterm elections for Milei now, is will the Peronist urge to be easier on people and not care about the long-term numbers outweigh the reformist urge? And nobody knows what's going to happen next month.
Mhm. Staying with the fiscal populism, Greg, can you talk about the US policy today and the odd duality of Argentina then and now, and the US then and now? This can feed into the general conversation of debt and fiscal populism around the world at this time.
Absolutely. From the beginning of writing my book in like 2017, I got this eerie feeling the US was becoming Argentina. And I had a research assistant from Argentina who's a
Mm.
graduate student at Columbia. And every time we met for coffee to talk about Argentina and my research,
Right.
something else happened under Trump won. Like there was a strike and Trump tried to block the strike, but then the um, the guys who the aircraft controllers they all stopped going to work, and so then Trump had to pay them, and
Right.
they broke Trump, and it's just like those things happen in Argentina all the time. And I said, see, we're becoming Argentina, and then every month another thing has happened, and then Trump too is like bringing it to another level. So for me, the fiscal populism and the division over truth and the for and against me dividing of the country has been a sort of 8-year process. And right now, it is zero surprise to me that Trump has gone after statistics. It's zero surprise to me he's gone after the central bank. And it's zero surprise even it's something Kirchner did early is he's cutting off automatic funding for FEMA, the emergency management agency, so that if there's a big storm, hurricane that hits Florida, FEMA rushes money to Florida. And they're saying you don't get automatic money anymore because the White House wants to decide who gets money when, because then the White House can put political conditions on everything. The essence of fiscal populism is the executive holds all the money and could extract concessions from everyone. And that is becoming approvals for mergers, tariff exemptions, money for any emergency. All the power to do anything is getting sucked in to our executive in a way we have never seen, but that people from Argentina and I suspect India are very familiar with. And they spent years to reform to stop bureaucrats from being able to interfere in business because that's unproductive. And what's happening is most Americans don't understand the cost of this because it's so new and it's only affecting a small number of people, and you don't hear what's happening behind the scenes. But for those of us who've lived and worked in dozens of developing countries, we know the cost and we're very scared. But it turns out, and I talked to a top portfolio manager at a very large US firm, an emerging markets manager, and I said, do your other managers who grew up in the US and do US assets, do they understand what's happening? And he
Mm.
said, no, but I'm telling them.
Interesting. What are the systemic lessons of the Argentinian cases for sovereign debt restructuring, Greg, and lesson developments since 2016? Any other remaining challenges pertaining to developing markets debt, in your opinion?
Well, I think it's useful to be even more general and to think about the euro area debt crisis and developing
Yeah.
market debt crisis. And
Mm.
what I'd say is most people tend to gravitate to looking at debt to GDP and to
Mm.
think of it as a stock problem. And yes, the US debt to GDP is rising, France has risen, UK has risen, but in reality, it's a flow problem 95% of the time. It's just that the political authorities are having trouble marshaling the political will to do anything about the year-to-year budget imbalances because they don't want to extend retirement, they don't want to ration medical care, they don't want to raise taxes, they're unwilling to distribute pain. All the politicians want to do is give away goodies. And so there are exceptions. Argentina had such a big stock problem, it needed a 50 to 2/3 haircut on its debt. Greece had a such big stock problem, you had to write down the debt. But most of the sovereign debt restructurings in history push out the debt, maybe lower the coupon a bit, and that's the predominant part of the problem. And so I urge people to look not at debt to GDP, but interest expense to revenue. And your trouble point is when that gets over 20. And it's in these
Right.
years the US is rapidly going from 15 to 25 to 30. And that's where, like a family, you can spend 5 to 7% of your household income paying your credit card bill, but you can't pay 50%. And that's why I had to help restructure Jamaica's debt in 2010, because its interest expense to revenue was like 55%. The
Right.
IMF said, we won't lend you money unless you reduce it. And we didn't haircut the debt, but we dropped the coupons so that the interest was reduced to, let's say, 30% of GDP, 30% of revenue. And they, since then, with a hiccup along the way, Jamaica has reduced its debt to GDP from 140 to 70 through fiscal discipline. And they've continued to slowly grow, and they haven't fallen apart for all the fiscal discipline. So it's a kind of unsung story that it's a flow problem dealing with the budget in most cases. So when I look at the US and France, it's about politics.
Right. So, generally speaking, Greg, whenever there is a sovereign debt crisis, I think revenue deficit is the main target area because ultimately the interest payment obligations become the moot point in such scenarios. So, staying with this and your recent commentary in the New York Times. What is your outlook for the U.S. fiscal and monetary policies at this time? You can also
Well,
talk about the White House acting like a bad Argentine policymaker, as you mentioned in your commentary.
yeah, let me say a
Mm.
few things. Number one is I urge people to look at the relatively sparse writings of former IMF economist Desmond Lockman, a fellow at the American Enterprise Institute. Last week, he wrote an article, a short article in the US periodical Barron's, and
Yeah,
he compares French and US debt dynamics and saying we have a problem here. Now, I listened to Desmond. My firm previously had been Solomon Brothers before it was purchased by Travelers and purchased Citi. So he had in the late 90s been saying Argentina's not going to make it. And that was kind of a bit of a scandal among our Argentine client. So he kind of had to say that quietly after a while. And then but he was right. And all the funds who talked to him remember that. And around 2008, when he had gone somewhere else and I had had a different journey, he started saying Greece wasn't going to make it. So he was always 2 to 3 years early. And he doesn't give a lot of opinion. So for him to be raising concerns about the US budget bill and the trajectory in France and the US, but he made an interesting point in this article to your question. He said the US prints its own currency and it can adjust through both fiscal and exchange rate. But
right,
France, being part of the euro, would be stuck with more of a tough Greece style adjustment, which is much more politically painful. And so he seems to be a little bit more worried if France doesn't head this off. But for me, it's political. It is completely political. It's not financial yet. There's room to get out of it. But you have too small a center, and you have the left and right that want to overspend. How do you scare the wings enough and the people enough that if they go down this path, they're all going to lose, like Argentina?
right.
That's politics. And I just watch it, how to shift the mind's eye. I know I wrote my book about defaulting and how bad it is. I hope people read it, but it's not going to be a mass seller in France. But I am speaking about this.
Yeah. So, staying with Europe, Greg, what are your views on debt and monetary policy in the UK, France, also China and Japan at this time? You can touch upon the macro realities these regions are facing right now. I'm actually coming from the IMF bailout that France might seek soon.
Yeah, wouldn't really expect France to have to do that. And whether it's the UK or France, for some economist or commentator to talk about that is a good scare tactic to get attention from policymakers. It's so offensive to the sovereignty of a country to have these international bureaucrats telling you where to cut your budget, that's just a talking point now. The way you adjust is the market yields skyrocket.
Right,
And then you're forced to make a change. It's a market discipline. It's not sort of an IMF discipline in the first case. And as you saw, Trump overdid it on tariffs in his first round, and the market discipline went very fast. We got to know his pain point, and then people called it the taco trade. Trump always
right,
chickens out, which I'm kind of regret doing because then he started acting tougher than he would and doing kind of crazy things. So it's like, I think so then you have to differentiate the flexibility of countries to respond in their politics. China's debt has been creeping up quite a lot in aggregate. and it has had a lot of problems with its real estate, its municipal finance, where they're underfunding. But they don't have a free float of their currency, and they can um, suppress the market. And the question is, well, will interest rates on deposits get so low? How are people going to keep people happy? But
Mm,
that's a very slow process. Japan, I'm not the expert on how its balance sheet and its flows are working now. It's kind of like it took me 7 years to figure out Argentina. It would
mm,
take me a couple of years to figure out Japan. So I think
mm,
it would be well advised to find a guest who talks for a whole hour just about Japan and what's been happening on the curve. I'm sure a lot of
mm,
people will be fascinated to hear it.
I know it's a very complicated topic, Greg, but I mean, all the people that I've been talking to, it seems that the long end of the curve is a problem for almost every country right now. So we can't really just pinpoint France as, or maybe UK having that problem. I think every country has that problem. So it's more of a global thing right now.
It is, and in 1986, after I graduated college, I visited India with a friend who is of Indian origin,
Right.
and we did something that was new to me. The family, her cousins, they um, either brought it out of the bank or brought us to the bank to go to the
Mm,
safety deposit box to show the gold jewelry.
right. What
And
happened
that
then?
was really stunning.
Mm,
And I hadn't appreciated how many people in certain parts of the world keep their wealth in physical gold.
yeah.
And for Americans, for my entire life, it is always the bank, it is always interest bearing deposits. For my entire life, I would not for a second think of buying a commodity that doesn't earn interest because that's crazy. I'm not a speculator. But
Mm,
what's happening is if you have a country who is attacking its central bank, is going all in on crypto, which for me competes with the dollar, it's
mm,
like, and the gold is skyrocketing. It's like, if you don't want people to trust your currency, you're promoting alternatives, you're having fights with all of your allies,
mm,
um, you're undermining confidence in its store of value. Whether the US runs for gold or not, I think a lot of people in the rest of the world were saying, do I really want all my assets in gold? So
right.
the FT has great coverage of this. They had another article today about do central banks own more gold than they do treasuries? They
Mm,
argue today it was mostly a mark to market effect on the price of gold. They're not necessarily buying so many ounces, but there's something that I'm watching carefully, which
yeah.
is are we really going to have a rush in China, in India, and Philippines, people buying safe deposit boxes, people buying physical gold, a kind of meltdown of confidence in paper money? So when we talk about the long end, I'm also watching the price of gold, and I have never done so in my life. And
Yeah.
it's very odd.
So staying with this transition from the USD to gold, Greg, if central bankers feel that the US dollar isn't the safe asset as a store of value, then financing US debt will become more expensive. And this is going to further deteriorate the situation uh, as far as the USD remaining a reserve currency. Any thoughts on this?
Well, I'm American and I did work at Treasury, and I do believe the US dollar is the best currency in the world.
Right,
I have my own skepticism about the dynamism of the euro area. I have my own skepticism about the euro, and I have my own skepticism about China. And
right.
and developing countries, local currency, it's fine to own a diversified portfolio in a fund of local currencies. But when it comes to the bulk of the assets, I still think it's prudent to own dollars. But what you're doing is you're messing with the foundation of the entire global economy here. And
Right.
if you mess it up, you destroy everything. We haven't messed it up yet. We're just going in a scary direction. So it's like the pace of debt is slow. It's like a super tanker. You get in trouble over 5 and 10 years, not 1 or 2 years. So when we
Right.
see alarming predictions, and as I said with Desmond, he tended to predict developing countries or Greece 2 or 3 years early. For someone
Right.
like the US or France or UK, you're more years forward. So I'm wouldn't wouldn't go so far to make it an issue now, but it's something to watch and to see. We understand the domestic politics of Trump and Besson and the central bank. They want rates incrementally lower. How far are they going to push it? And then
Right.
watching how is gold reacting? How is the long end reacting? There is a potential for a run, but that's not my first case expectation. But the probability should be zero. We shouldn't be messing with this. See what I'm saying? It's like low probability, but very high damage situation. And going back to 1982, what knocked over those 35 emerging markets countries was Volcker. To squeeze inflation out of the US, he shocked real rates in the US. Because
Mm.
all these developing countries borrowed bank loans on a floating rate, their interest coupons went way, way higher and they all toppled. They had
Right.
had an oil shock, they had to fund it, and then you put the interest shock on top of it, they all fell over. Without the interest rate shock, some of them would have had trouble, but not all of them. And so that's a lesson of the cost if the US messes up and has extreme rate volatility. But my base case is still we will cut rates. We're going into a recession of some sort. Bonds will rally a bit, but it's more the tonality. And that's why I wrote a piece a month ago about Trump going over to the Fed in person and harassing Powell, because that crosses a line. And I actually started a Substack newsletter because I was trying to get it out in a few newspapers and they were just being too slow. And it's basically saying this is the point of no return, because on TV he went over there. For Trump, that means he has to win. He can't go into the midterm elections starting a big fight and not winning. And that will be damaging. And so I tend to comment on big policy moves like that. I'm watching that a lot. And that's the sort of thing I worry about. But they can also back off like they did on tariffs. And they keep flexible and shift around and change narratives a lot. A victory in Ukraine, for example, or the Middle East might give them room to back off on something else. So it's it's very volatile.
In the context of your recent commentaries on US debt, Greg, how should we think about the US trade policy and foreign policy in this current context? Is there a method to the madness to the mix of policies at home and abroad?
The only method to the madness is madness, in a sense that, and I learned this from Argentina,
Right.
which is Kirchner as President Nestor, the first Kirchner, before his wife followed him. He would say things in the domestic press and the international press all the time to please his domestic audience that horrified and angered his neighbors, the IMF, the US, the rest of the world. Everything he said was for his domestic base. There was no manners with respect to the rest of the world, and he burnt his bridges with everyone because it was the domestic politics was all that mattered to him. And that's what Trump's doing. We used to have leaders who could deal with domestic issues in a domestic way and then speak a different cooperative language with leaders from the world because they valued cooperation in those ongoing relationships. But now Trump has no problem, as you know, throwing an important relationship under the bus for a headline. This is not a behavior in foreign policy we have seen in my memory from a US leader. And maybe he cleans it up this way or that, but this is very erratic. And for me, it is always about the effect on TV. He's running, remember when Zelensky first visited the White House? He has set it up like a reality TV show. It's a set. And there he is being president, and you're all invited in to be president with Trump and watch him being a big shot. And then Zelensky said, no, but I want security guarantees. And that wasn't his script. And then they railed at him. And that may have made exciting TV for him and make him look like a big shot, but that wasn't good international politics, and that fed into Putin. And so it's all like that scene. And so the madness is understand how it will look to US domestic voters, positioning himself as the great savior, the strong man. And from that comes the next policy action, which is the other way I speak about it, which is more general, not domestic policy, overwhelming foreign policy. It's just that politics trumps policy.
Right.
Whatever it is, it's about how it looks and will it help him get elected in the midterm elections.
Yes.
That's all he cares about. And some policymaker economists say, well, we really shouldn't spend so much because the market, blah, 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 blah. And he says, it doesn't matter. We'll deal with it later. We can't do anything if we don't win the midterm election and keep the House and the Senate. And that's how he shut down the fiscal conservatives and the Republicans. Oh, I'll do a little this, I'll do a little that. And then he backs off of those promises. And so it's politics over policy. And it's shocking, but that's what we see every single day.
Right. What is the key reason for the looming debt crisis in the US, Greg? Is it defense spending, aging population, demographic changes, or fiscal mismanagement? I know the debt crisis is a perennial issue. It comes up almost every year, but right now it seems to be serious. What are your thoughts on this?
Well, your question is great. And for any country that I give advice to or study, you actually have to spend some time studying how did the country accumulate its debt? Because even if you restructure the debt, it's like a factory that pollutes in a valley. You can find a way to clear out all the pollution, but if you don't shut down the factory, you're going to pollute it again. And so you have this machine that's creating deficits in debt. But for the US, our debt to GDP was almost gone at the end of the 90s. Our debt was skyrocketing under Reagan and the tax cuts. George W. Bush took a bullet and raised taxes to balance it and wasn't reelected. Remember that read my lips, no new taxes? Then he raised taxes, and no Republican has ever raised a tax since then for political reasons. But George H.W. Bush was responsible, and Clinton was responsible, and by the end of that decade, rates were low, confidence in the US dollar was strong, our economy was growing, tech was booming, and our debt was about to disappear. People worried about what will be our benchmark when there are no more treasuries. Then we had series after series of things happen. First, George W. Bush, tax cuts. Number two, we had the war, which was costing us like $1 billion a day. So we put trillions more debt for the Gulf wars in Afghanistan. Usually, when you're in a war, you raise taxes to pay for it. Bush did not do that. We put it on the balance sheet. Then we had the great financial crisis, put billions more on the balance sheet to bail out the economy. Then we're dancing on that debt, and Obama was relatively careful, but it still was creeping up very slowly with good monitoring of it. But then comes Trump and he does maxi tax cuts again. And then comes COVID. And we have the biggest bailout in history, trillions added to the balance sheet like there's no tomorrow. And then Biden, the bailouts proved helpful to get the economy going again and not going at a subpar pace like the rest of the world. But the final bailout package was probably too much and helped stimulate inflation. But then, despite complaining about it, Trump was continuing spending at the later Biden rate. And so what we have built up the debt with incidents, accidents, war, crisis, health crisis, but then on top of it, instead of tightening our belt to wean ourselves off the war debt and the crisis debt, we're going for broke again and doing Ponzi finance. And the reason I say Ponzi finance is we refinance our principal, but when an interest coupon is paid, we have to borrow that entire amount of the interest too. So interest is paid with a new investor.
Right.
That's
Right.
how when you take our growth rate in our primary surplus, we're financing all the coupons. So we're now on a very hockey stick accelerating debt because we've entered Ponzi finance zone. So that's very dangerous, but all we need to do is have a medium-term plan to adjust our taxation and spending, a cooperative Congress. It'll be bitter and painful, but that's what we did in the 90s. With Bush, H.W. Bush, and Clinton, we actually worked and there were compromises and we were a healthy country. But there are no more compromises. Compromise is a dirty word.
But isn't gross debt in every country a Ponzi anyway? So it's evergreening of debt that is happening across the world. And I think that's how fiscal sustainability actually happens. Don't you think?
No, I think most debt
Mm,
is rolled over, and as long as
mm.
countries are growing steadily and
Yeah.
there is good attention to not having the debt grow. And so, as a
Mm,
debt expert, I'm not panicked by a debt to GDP
mm.
number, even if it's
Right.
slightly higher, like Italy and Belgium, or slightly lower
Mm,
in another country. France's was relatively low compared to Belgium and Italy 5 years ago, but I was much more
mm.
worried about it because it's not just the level of the debt, but the pace at which it is increasing every year.
Right.
Because the primary deficit is reflective of the inability of the political system to balance its budget. And
Right.
so countries who are acting responsibly with good
Mm,
governance will be able to roll over their debt.
mm,
There will be no problem in the US or France or UK if they have a package where the numbers add up, the market says, fine, thank you, we're done
mm.
worrying. It's when the
Right.
political authorities cannot come up with a credible plan that people
Mm,
start running for the exit. And yeah, it hurts, but you either pay for it now or you pay for it later.
mm. Greg, we know that government bonds are the bedrock of capital markets, serving as benchmarks. The yields of these influence other financial instruments such as corporate bonds, mortgages, and derivatives. In actuality, many financial transactions use government securities as collateral for hedging against risk and guide pricing. In your opinion, Greg, how real is the fear of a US debt crisis impacting the global financial market in the near term?
Zero. Um,
Zero?
the plumbing, the plumbing will be fine. The risk
Yeah.
is it's much more economic and political because
Mm.
it's it it's a very liquid market. It is a huge market. And here I'll
Right.
distinguish the UK has, let's say, five big pension funds who own most of the gilts. So that's why you had a problem under Liz Truss, because you do something bad, liquidity for a huge percentage of the market can dry up. You feel it immediately. Immediately. The US is infinitely liquid. The plumbing is great. That is not a worry at all. The worry for me is that when you lose control of the long end, because even if you control the Fed and you lower the short end, people don't trust inflation expectations. Mortgage costs stay high in the US, then people can't buy houses and the economy slows down and it chokes us to death over a decade and makes people unhappy and causes political division. So I'm
Right.
much more worried about the slow moving process in a short or medium term, zero risk about it. I don't want people using crypto to settle stuff now and these
Mm.
things everybody's talking about that seems very unsafe to me. Treasuries are the safest, most efficient way to move big amounts around and to collateralize them, and I would never touch that.
Right. Emerging market economies are already facing the highest real financing costs in a decade, and I know that you alluded to this earlier, and may now need to refinance their debt and fund fiscal spending at a higher cost. What is your opinion on this, Greg, given this background that we're in right now?
It's it it depends country by country. And the difference between 1982 and today is in 1982, all of the foreign debt of the developing world was in dollars. They
Right.
did not have local capital markets. And after the
Mm.
Brady plans and after the Mexico peso crisis in 94, which was
Right.
a big wake up call, every country that I worked with, like Mexico and Brazil and Peru and Colombia, they all said, we've got to build our local markets. So they changed their pension laws to encourage savings. Even in the late 90s, Mexico's longest domestic bond was 2 years. And they said, we
Mm.
need a full yield curve. And so between like
Right.
95 and 2005, Mexico and all the other countries went out to 30 years fixed rate domestic currency bonds. So you
Okay.
can buy M bonos across the curve. At a certain point, Brazil's like 90% of its funding is in domestic currency. A very little amount of Mexico, Brazil, Peru is left in dollars. They're funding through big pools of savings in their local currency, and international investors started buying their local currency stuff anyway. So, the transmission mechanism from US rates to the local portfolios is attenuated for the biggest, more sophisticated countries. You'll tend to have for sub Saharan Africa, they're dependent on first multilateral borrowing, second bilateral borrowing, and third partially bond deals at a pretty high cost. They're getting squeezed, but a lot of them had the benefit of debt reduction under HIPC and
Right.
haven't fully built their debt up to the same level. Everyone was hurt by the bump of spending for COVID. So
Mm.
yes, interest has gone up. That is squeezing countries. I wish rates were lower. I wish there was more official finance that was cheap, but there's no evidence at all of a systemic crisis in countries. It's just painful.
Right. It's actually a learning for me, Greg, that the yield curve is actually a recent phenomena. I mean, for somebody who was born in the 1980s, uh, I think there's something that I had no idea that the yield curve was sort of invented in the emerging worlds in the 1990s.
Yeah. And I would say debt management as a science was built in the 90s. And
Mm,
I went and visited with the Colombians who I was advising in like 95 to a lot of debt
mm,
offices in Europe. They had been scared by the Mexico peso crisis. They wanted to
mm,
actively manage their debt. And the
mm,
Belgians who had formalized their debt management said, oh, like 5 years ago, let's say, they said we had
mm,
one person with a spreadsheet who kept track of
mm.
all of our borrowing. And this was a
Yeah.
country with 100% debt to GDP.
Mm,
And with Ireland was first. They set up the National Treasury Management Agency. They completely professionalized it. They offered better salaries. It was a separate agency. They had all the best models. And everybody around Europe said, we want to have really sophisticated offices. New Zealand did the same, set up a debt
yeah.
management office in London. Sweden has always had a debt office. So they were always at the forefront. And Europe, Latin America, at least Colombia, we borrowed from that. And we said, okay, what are your policies? What are your procedures? How many people do you have? And
Mm,
borrowed all that. So since the mid 90s, Colombia has had a debt team, Mexico, Chile, state of the art understanding. And
mm,
central bankers, because the IMF and the BIS have always shared a great pool of knowledge about payments and exchange rates, and they meet monthly and share market knowledge. But debt managers didn't have such a community. But
mm,
from the mid 90s, with the World Bank and the IMF and regional borrowers and global borrowers, there's a great community and it's highly professionalized. And I'll be really boring now. In a lot of countries, like in Africa, the data management was horrible. I go to Nigeria and they just have this pile of paper with all their debt. And that was, let's say, 2000. And by 2003, they've got computers whizzing with everything computerized. And so,
right.
with a lot of help from the IMF and the World Bank and the Commonwealth Secretariat and UNDP, countries all over, even the poorest countries, have completely computerized and professionalized their debt management. It's not perfect because it's hard.
Mm,
And it is something that's been professionalized. But if the political authorities spend too much, all this good work goes to waste.
right. Very interesting, Greg. My final question before we end. The IMF projections, based on those projections, global public debt is likely to reach 100% of global GDP by 2030. That's 10% higher than the pre-COVID era, as on 2019. Do you see this reaching that level much quicker, Greg, given the sovereign debt overhangs that we are witnessing right now? And what steps are required, uh, to keep that at current levels or even pre-COVID levels, for that matter?
Well, the aggregate global number will be driven by the largest economies, and the
Right.
US and China keep ticking up. And
Mm,
this party can't go on forever. So, am I worried about 2030? No. But I'm worried if like the annual rate of increase of that number starts going up. So if
mm,
the IMS number this year is 130, but next year it's 135, the
right.
pace at which fiat money debt is growing should be telling you to buy gold. And it's
Right.
all about the responsibility and cohesion of policymakers within their countries and around the world to even care about these things. And we're
Right.
just not seeing that. If you talk about policy and you talk about numbers, you just get shouted down. And maybe there's some
Mm,
countries where that's not true, but being in the United States right now,
mm,
it's it's a a very strange world to be in where policy and economics is just doesn't appear to be valued. So I'm hoping for, a switch back towards rationality and even tonedness and respect for the market and market processes and orderly business and things. But usually something has to happen to wake people up and cause a shift. So, whether it's a midterm election or the next presidential election or a crisis in France, something's going to happen. There will be volatility. I don't think it's
Right.
fatal, but it's time to watch the numbers very carefully, to read the scholars, and read all the sources commenting on this high frequency.
Right.
And so I'm pleased to talk to you and give my thoughts about this. And I do hope people read my book. It is helpful for understanding the essence and character of debt crises as well as technical things. I do have this new newsletter on which is called on Substack, which is called Greg Makoff's Fool Me Twice. It
Right.
says that because fool me once, fine, but fool me twice. I'm like,
Yes.
don't mess with me. I've seen this before. So there's a bit of attitude
Yeah.
in there. And I
Yeah.
ran with that one. I've only published
Mm,
one. I've put
mm,
stuff in the Times in the FT, but for a lot of things, it's just quicker to put it out.
yeah.
But it's occasional and it's free. I couldn't imagine commenting every day on what's going on because as a debt
Mm,
expert, you don't have that many things to say.
right.
But thank you for talking, and good luck with the podcast. You've had a lot of interesting speakers, and I look forward to following it.
Thank you very much, Greg. It was wonderful speaking to you, and I'm sure our audience, today's podcast would be of very high value for our audience. A lot of learnings that even I've collected while speaking with you. Thank you very much for the time.